Magandang
I just
umaga
had a
rin,
look
David.
at the interview you did with our other friends. It seems you're removing these big hikes off the table now. Why so confident?
Well, I think with a 75, the well 225s, a 75, and then a 50. I think we have more or less succeeded in anchoring inflationary expectations. Also, our forecast is that if we had done nothing, average inflation next year will be around 4%, which is too close for comfort. So that's why we increased by 50. Of course, many other things can happen that can bring up our inflation forecast again. As you know, David, it's very fluid. Like you have uh, hopefully falling oil and commodity prices, which we're beginning to observe. On the other side, you have the Fed uh, repeating the 75s, right? Which I think is not very likely. So those are the things that make it rather uncertain. So it can go either way. So depending on how to me the biggest source of uncertainty now is how big will the Fed rate hikes will be and how many. And of course,
Right.
although we will not match them point per point, if they are large, we have to react.
Understood. Now,
The
since you mentioned inflation, then, do you see inflation peaking before the end of the year? And if you do, your current projections basically show you when do you think inflation peaks? Which month?
Okay, it's around September, October, or November. But remember, when it peaks, it's still much higher than our 4%. So we're not the year on year will probably not be below. Will be close to 3, maybe already in the second half of next year. So since our target is agreed upon with the government is the average inflation rate for the year. The average of the to 12 headline inflation rates for the year. So we're sure that the target in the first half of the year will be above 4, but our forecast is that it will be close to 3 the second half of next year. So if that happens, then we have achieved our goal of meeting the inflation target next year. Of course, there's nothing we can do to
Governor,
meet the inflation targets this year. Yes.
sure. So I have to ask you about where rates are going to be then. The market, or at least analysts, are forecasting another 75 basis points of hikes up until this year. Are you looking at just where rates are going to be? What is that rate going to be by year end in your current scenarios?
Well, the scenario where the Fed again does 75 and maybe another 50, clearly we have to react. But of course, the reason I'm not willing to tell you exactly what the rates will be is I'm just one vote, so I have to also convince the other board members. But my
Fair.
view is if that scenario is going to happen, we have to react. Exactly by how much I cannot tell you because I'm just, as I said, I'm just one vote.
Fair enough. Governor, then, are you going to be still pushing for cutting the triple R? Then how do you factor that in or square that with normalization of policy?
Okay, we don't want to confuse the market, so we will postpone the reduction of the triple Rs. The reason for reducing it is that our regulatory relief that said that loans to medium and small scale industries will no longer count as compliant with meeting reserve requirements. That's equivalent to raising the triple R by 200 basis points. So in the original plan, then we should offset it. But given the current scenario, effectively we will allow it expire, which means that de facto there's some tightening. Now, the reason we're confident that that's not going to hurt is that we're improving our ability to sterilize. That is, remember, we bought a lot of government securities because of COVID. And we have to make sure that not all of that becomes money supply. So our confidence is that we're creating facilities that effectively can borrow from the public. When we're confident with that, we will be sure that whatever we do to the reserve requirement, we can offset through monetary operations. When that happens, then we will go for single-digit reserve requirements. The reason it's important to go to single-digit requirements is that the financial operations that we don't regulate are not covered by reserve requirements. So, yeah, fintech and so on and so forth. So it's very bad for us to have high reserve requirements because effectively we will be putting the banks at a great disadvantage relative to lenders who are not covered by a regulation. So that's still high priority, but we must develop the ability to reduce the impact on money supply of the reserve requirements. I'm confident that ability will be there by next year. Because then, fortunately, we got a law that allowed us to borrow from the public.
Governor Medalla, I'll put the rate hiking cycle and that together since we're talking about a timeline. You just mentioned next year. Are you saying you're postponing this until after the tightening cycle? And along those lines, do you see the tightening cycle ending this year as far as interest rates are concerned?
Well, that's one scenario. In fact, that will be the main scenario. In fact, the view is that if the U.S. goes into recession, the price of our imports will go down, and therefore the inflationary pressures will actually go down as well. So that's the main scenario. But of course, anything can happen, right?
Certainly can in these uncertain times, Governor. I have to wonder, the rate hikings that you've done so far, do you think it's enough to at least stem the depreciation in the currency right now? You've been burning through a lot of your reserves. Are you willing to continue to do so?
Well, the point is that what moves the peso now is, things that happen in the U.S. is the major factor, and also the things that happen to the price of our imports, because we did a calculation, 2/3 of the increase in our trade deficit was due to increased prices of our imports, and clearly that will increase demand for dollars. By the way, in that particular instance, it's healthy to let the peso depreciate because dollars are getting scarce because price of our imports the price of our imports is rising. Now, the only reason we are reluctant to let the market take its natural course is, of course, if the exchange rate changes are too large, it may disanchor inflationary expectations. So that's really the trade-off. By and large, changes in relative prices, as we economists usually think, are good for the economy. It's signaling the market which parts of the economy must expand and which parts of the economy must contract. But if that price signal that changes relative price also disanchors expectations about the general price level, then that's no longer true. So that's what we're always on the lookout for.
Right, these big swings, right? And you don't want to keep people guessing really how much they'll need to pay, especially for fuel, Governor, of course, locally. Yeah. Let me end on this then. Do I get a sense that while inflation is number one priority, do you see yourself needing to then focus on the recovery and growth at some point? In other words, what I'm trying to get to is there a minimum level of growth to which you want to see the economy grow, regardless of what happens with the inflation story?
Well, fortunately, our forecast is that there will be less and less lockdowns. So mobility will improve, and that alone will overpower the negative effects of our interest rate hikes. Okay, so for instance, a lot of people who were infected, nearly all of them did not go to the hospital. Well, I'm actually looking at BSP statistics, okay? Our employees, how many of them got infected and how many of them ended up in the hospital? And thank God, so far the answer is 0. So if the COVID situation is like that, a lot of people are getting infected, but the hospitals are not being congested. That's actually a powerful boost to the economy that will actually overpower whatever negative effects our interest rate hikes do. So that's the optimistic scenario. The rising mobility, more people going to the malls, more people going to the restaurants, will increase demand. Of course, the other side is expensive oil. By the way, this is very clear from our data. Expensive oil, expensive food, which people will have to spend on regardless on the price, means less money for other things. So that is the biggest contractionary factor thus far, which is we actually did observe that consumption levels are already at pre-pandemic levels until all these price increases came from. And we can actually see the discretionary or what we call non-essential spending fell because you have no choice. You have to go to work. You have to pay for fuel. You have to pay for electricity. And demand for products of the rest of the economy will suffer. Now, hopefully, that one will be easing because when you look at futures prices, they're signaling that prices will go down.